So welcome everybody to this edition of Hardman Talks. My name is Keith Hiscock and I'm the CEO of Hardman Co. We're delighted today to be joined by Helen Steers, who's the manager of the investment trust Pantheon International. This is an open forum presentation with discussion about the role of private equity in general and PIN in particular in financing entrepreneurship, innovation and growth. Helen, over to you.
Great, thank you very much indeed, Keith, and it's absolutely great to be here today, and I'm absolutely delighted to have the invitation to speak. So today I'd like to take a few minutes just to walk through some sort of the myths and the realities about private equity. There are no shortage of headlines about private equity, as you can see from this slide. Some of them good, some of them not so good. And I think part of this is to do with some of the misconceptions that people might have about private equity. Some of this goes actually back quite a long way to the great financial crisis. So really back in the midst of time now. But I think over the next few minutes, it would be good if I could just sort of highlight some of the realities that we see today in private equity, and also talk about how we think that private equity can actually provide some of the solutions to today's problems. So maybe just stepping back quickly and looking at what has happened, actually, the evolution of privately backed funding over the last few years, and putting that in the context of the number of publicly quoted companies versus the number of privately quoted companies. You can see the stats here on the page. Over the last 20 years, actually, the number of publicly quoted companies has roughly halved. This chart actually shows more recent stats over the last 10 years. And you can see that despite some very active IPO markets, actually the number of publicly quoted companies has remained pretty static. In fact, it's gone down by about 0.1% per annum. In contrast, the number of private equity-backed companies has actually been on the increase, and it's been increasing by about 12% per annum. Why is this? Well, I'll go into some of the reasons during this presentation. But I think, first of all, companies can actually stay private for longer because they can attract the funding these days, whereas 20 years ago, a company would have to go public in order to be able to attract a very large round of financing. Nowadays, there are numerous private equity and venture capital funds that are able to provide the funding, and therefore companies don't actually have to go public. The second big reason is that companies are looking for more than just capital. They're looking for expertise. They're looking for people that can help them grow their companies and take them to the next stage. And they're turning to private equity and venture capital managers to do that because they can get the expertise as well as the funding. Also, it has to be said that many of the rules and regulations around publicly quoted companies haven't helped. And the short-termism that sort of focus on quarterly earnings sometimes puts entrepreneurs and puts families off quoting their companies. So I think there's some good reasons why there has been this rise in the number of privately run companies versus the public universe. But of course, that's just the number of companies. If we look at the assets under management, clearly there's been a significant inflow of capital in both public markets and private markets over the last few decades, to the point where now the total value of mutual funds just in the United States is approaching $30 trillion. The other really interesting phenomenon that's happened over the last few decades is that there's been this rise in sort of the pacification of public markets. So as you can see on the right-hand chart here, 45% of the assets managed in mutual funds in the US are actually now in passively managed funds. In fact, somebody once told me that there are now more ETFs and more sort of baskets of securities than there are actual individual securities in the US, which is quite phenomenal. And then if we look at the rates of growth and what's actually been happening over the last few years with private equity versus or private markets versus the public markets, you can see that clearly global equities have increased in assets under management pretty strongly over the last decade or so, very strong growth. But actually, private markets have increased even further in terms of assets under management. And that's really come about because investors, particularly institutional investors, have been attracted by the higher returns on offer in private equity and private markets more generally, and also by the diversification benefits that you get from private markets. So you can see there's been a big influx. But if you take all private markets on the sort of top right-hand set of charts as a percentage of all financial assets, you can see that although there has been an increase, in December 2010, private markets accounted for just over 3% of financial assets, and nowadays it's more like 5%. It's still a very small slice of the market. And we think, and so do other commentators, think that there is still room to grow in private markets. So we believe that the projections that are out there, so for example, Preqin is forecasting that assets under management in the whole of private markets, will actually expand to close to 12 trillion by 2025. We think that's quite possible as private markets take a larger slice of financial assets in general. So, we talked a little bit here about, the myth actually of too much money. People are always saying there's too much capital in private markets. And I think if you put it in context, you can see it's still a small slice of overall markets. But there's plenty of other myths out there about private equity. And as I mentioned at the beginning, a lot of these are to do with some what I consider to be rather sort of outdated views about what private equity actually is. So a couple of decades ago, private equity tended to get a bad reputation. It was tarred with the brush of sort of financial engineer, and maybe there was little appreciation actually of what private equity in its essence was trying to do. These days, the best private equity funds use financial engineering as a tool, and clearly they're going to get the best capital structures in their portfolio companies. But actually, what they are doing is spending a lot of time with the portfolio companies, investing in their central resources to be able to help their companies grow effectively and sustainably over the long term. So a typical private equity firm these days may have 100 investment professionals going out and looking for the companies, sourcing the deals, putting together the transactions. But they'll probably have another 100 people on staff to help with operating improvements with the businesses to really help those companies get to the next stage in growth. And I'll talk about some examples later, which hopefully will put a little bit of flesh on the bone. But you may be wondering as well how private equity is really positioned in the current climate. There are no shortage of risks out there. We have geopolitical risk, not just with the war in Ukraine, but with other geopolitical risks which are bubbling around the world. And we have the very real risk of inflation, and in fact, seeing this already coming through really across the world. And then there's all sorts of things going on in various different sectors. So we're seeing sort of diverging sector trends and different companies coping with these trends in different ways. And I suppose finally, what everybody is worried about as well is the high valuation environment. And we spend a lot of time looking at that when we make our new investments. So how can private equity help with all of this? Well, in terms of navigating the environment, which is a difficult environment at the moment, private equity can be both flexible and nimble, so taking advantage actually of dislocations and disruptions in the market, but also can take a long-term view. So because private equity managers investing today will not be exiting their businesses for at least 5 years, and then even then they may not actually have to exit the businesses. Then they can hold and choose the time when they decide to realize their investments. They can afford to take this longer term view, and they can afford to invest in their companies. So they can afford to take decisions that may actually be difficult decisions to make if the company was a publicly quoted company. So, for example, they may choose, instead of maximizing profit today, to churn those profits back into investment in the businesses for all sorts of good reasons. In terms of inflation risk, so we get a lot of questions about inflation risk, and I think what I would like to stress here is that the sort of companies that we're investing in are companies which are resilient, are able to navigate a high inflation environment. They tend to be companies which dominate their particular market niches. They have moats, protective moats around their businesses, and they're able to pass on costs. They're able to protect their businesses to a certain extent from inflation risks. And I'll give some examples of that later. In terms of diverging sector trends, so the way to think about this is by looking at niche sectors. So while overall sectors may have certain difficulties, there will be certain areas within sectors that private equity managers will be able to identify and to capitalize on. And they can do this because very often they have sector specialists on staff that know everything there is to know about healthcare or information technology or financial services. And they're then able to take action. They have strong governance over the portfolio companies. Generally, private equity managers take a controlling position in their businesses. If it's not a controlling business, controlling interest is a position of significant influence. They can appoint people to the board of directors. They can change key roles in management, and they can bring in the right sort of expertise to help the companies navigate difficult environments. And of course, it's important to say as well that there is very strong alignment between the company management, so the portfolio company managers, who in most cases are investing in the business alongside a private equity manager, all the way through to the end investors. So it's one of the key tenets really of private equity is this alignment of interests, so that if a company does well, everybody does well, company management, private equity firm, and the end investors. So I think those are important points to make, and I'll give some examples later that will bring some of this to life. The other myth I'd like to sort of talk about is that private equity is really sort of disjointed from the real economy. There's been a number of studies that have been published recently on both sides of the Atlantic, which talk about the contribution of private equity to the economy. So in Europe, you can see the stats there. About 4% of Europe's workforce is employed by private equity or venture capital-backed companies. And in the US, you can see again the stats there. And in fact, the British Venture Capital Association has just published a report. It came out at the end of last week, all about how British venture capital and private equity firms are supporting the real economy. And the statistics there are very much in line with what we can see there in Europe and the United States. So, for example, in the UK, almost 2 million people are employed by private equity or venture capital backed companies, and that represents around about 6% of the workforce. And the contribution to GDP of private equity and venture capital backed companies is around just over 100 billion pounds. And that represents about 5% of the UK's GDP. So private equity is important, and it is providing both boosts to GDP and employment, and it's actually providing good jobs in the environment as well. So a lot of the workers in private equity-backed jobs are knowledge workers or healthcare workers working in some of the biggest sectors that are backed by private equity. The other way in which private equity is helping the economy is by actually investing in disruption and investing in dislocated sectors and helping the economy actually adapt to new environments. So because private equity is nimble and can invest in particular niche subsectors, it's able to actually transform companies to help them cope better with particular environments. In terms of the big sort of underlying trends and tailwinds that we see in the environment at the moment, digitalisation and the whole IT revolution is one very key one, and I'll talk about that and its impact on private equity portfolio companies here. But there are other big secular trends that we've been investing behind for a long time, including healthcare, so aging demographics in the Western world, which is a fact, and companies that invest behind that tailwind are doing well. And we also have other tailwinds, such as supply chain transformations. Now, this has been accelerated by the COVID-19 pandemic, where companies were forced to find different suppliers and to work through different supply chains. And now, actually, with the Ukraine and Russia crisis, again, we're seeing companies having to adapt their supply mechanisms. And private equity can help with that, with specialist experts that can help portfolio companies adapt very quickly. Another key area and key tailwind is the energy transition. So sustainability and moving to green energy is a long-term tailwind, which isn't going away anytime soon. And the best private equity firms are finding ways in which to invest and take advantage actually of that tailwind. But maybe just taking that first tailwind, which is digitalisation and technology and how it's affecting every other sector, we really view technology as a horizontal as well as a pure vertical sector. And what I've done here on the slide is to give some examples of companies working in particular sectors that are being affected by technology. So I've got sort of 5 underlying sectors here, and the logos you can see at the top are portfolio companies that we've invested in. So these are actual PIP portfolio companies that are working in these various subsectors. So if we start on business and financial services, digitalisation has completely transformed business and financial services. So whether it's digital payments or insurtech or fintech, slowly but surely, the whole of the sector is being disrupted by technology. And to give you an example of a company that we invested in this sector, so Nexi, which is the third company there, is an Italian payments business. It's a company which issues debit and credit cards and also works with retailers with integrated digital payments. And this was a really interesting company. We invested alongside an Italian private equity fund, and we helped essentially what was a division of an Italian bank spin out and become a standalone business, just really focused on credit and debit cards and digital payments. And it was interesting to us because the Italian banking system was probably under digitalized at that point. People were not really using debit and credit cards as much as they do in other countries. So we really got behind a tailwind there. And Nexi actually has been a huge success. It's made a number of acquisitions and has now actually IPO'd on the Milan Stock Exchange, and we're slowly selling down our shares in that business. But it's been a huge success for us. Taking healthcare. So you've probably seen the impact already of digitalization on healthcare with things like digital health, with being able to consult a GP over the internet, so video consultations and things like that. But there's many other ways in which technology has helped to transform the whole healthcare sector. One of the companies that we're invested in is a UK company called Fourways, which is at the top logo there on the screen. And they provide teleradiology services. So essentially what they do is they interpret radiology readouts from a distance. And this company was actually really helpful during the onset of the COVID pandemic, because people couldn't go into hospitals, and actually technicians were worried, radiology technicians were worried about going into hospitals to interpret radiology readouts. So Fourways actually provided its services for free to NHS trusts to help keep radiology services going. In the industrial sector, another interesting one, maybe not an obvious candidate for digitalization, but clearly with the Internet of Things and with advanced automation of processes, there is a large impact of technology in the sector. One of the companies we've invested in here is a company called Armis. It's a deal that we did alongside one of our American technology funds, and it's a company which provides Internet of Things cybersecurity systems. So because you have a lot of interconnected devices now, or connected to the internet, the threat of cyber attacks is much, much, much greater. And Armis essentially provides the protection to enterprises for that. Consumer sector, clearly there's been a huge, huge influx and popularity of e-commerce, and there are some e-commerce logos on the page here too. But one interesting example that you may not think of as a digital brand is Olaplex, which is a US provider of hair care products. At the onset of the COVID crisis, this company was providing products essentially just through hair salons, through the hairstylist who suggested that you have a particular hair mask applied to your hair after having been washed and cut. Clearly, that part of the business really suffered greatly during the onset of COVID because hair salons were closed. So the company, with the help of the private equity firm that was an investor in this business, pivoted to a digital solution. And the company started selling its products through Amazon, but also through specialist sort of beauty sites, to the point where the company now obviously with all hair salons open again, is actually selling a great deal more of the products over the internet and online than they do through hair salons. And the company has grown absolutely phenomenally. So that's been a big success story and really made possible by the quick thinking of the private equity firm. And then finally, technology. Technology itself, information technology, is obviously benefiting from the digitalisation tailwind. And I've got some examples here on the page. One or two of these companies may be familiar to you. We co-invested actually with HG in Visma, which is a business which provides software as a service, business enterprise software to small enterprises in the Nordic region. And that's been a very big success, and I'm very proud to be associated with that business. But we've also got other companies there, for example, Recorded Future, which provides cybersecurity solutions, just for normal enterprises, so not the Internet of Things, as I was mentioning earlier. So just a few examples there of companies in the portfolio and the way in which they are being disrupted, but they are also disrupting their own sectors and creating growth and profit for those businesses. Just a few words on the back to the public markets, because tech companies, instead of going public, are actually staying private. So carrying on with the theme of the previous page, digitalisation and the big opportunities that are provided by technology. Tech companies used to go public as really their way out, but now they can stay private for longer. They can have rounds of financing from different private equity firms. There's more of a continuum of financing. And at the end of the day, they don't have to IPO. They can be sold to strategic buyers. They can be sold to other private equity firms. And they are indeed choosing to stay private for longer, as this chart shows. The net result is that the tech universe on the public side is actually dominated really by just a few of the very large players, and you'll be aware of the discussions around this. But you can see here from the statistics on the page that the percentage of the stock market which is concentrated in the larger tech companies has actually been growing over the years. And this, I think, presents some challenges for investors. By contrast, underneath all of these sort of big tech companies, you've got many private companies that are operating in niche sectors where they can be a lot more nimble and flexible, and frankly attack certain parts of the market that the big tech players are just too big and too cumbersome to get to. And I mentioned earlier exit routes. Frequently, we will sell one of our very fast-growing technology companies to a Microsoft or an Amazon, or indeed even to an Apple. So I just really wanted to put that in perspective, the large tech companies versus our smaller private companies. So maybe now just turning to PIP. So Pantheon International is an investment trust. It's been managed by Pantheon since inception. The company was actually floated on the London Stock Exchange in 1987, and at that time its market cap was £12 million. It's now an investment trust with 2.3 billion pounds in terms of its net asset value, and PIP offers both institutional and retail investors access to the very best of private equity across the world. It invests both directly into companies and also into top venture capital and private equity funds. These days, about 45% of the portfolio is invested directly into operating companies. And you can see that on the pie chart on the left. And that 45% has been built up through co-investments, where we invest directly into an operating company alongside a private equity manager, and also through secondaries in single companies. So where we can purchase a company alongside another manager and really give it another 3 or 4 years of life. In terms of the stages, we favour the mid-market and also growth equity. You can see that that's a majority of the portfolio. We've got about 4% invested in venture, which is a very exciting and high-octane part of the market, but it tends to be quite volatile. So we really only invest in the very best venture capital opportunities. You can see that's just 4% of the portfolio. In terms of the geographic split, it is a global portfolio. We've got just over 50% of net asset value actually in the United States, which is the deepest and most sophisticated market in the world. It also has a lot of these specialist managers, specialist sector managers in IT and healthcare that we like to invest alongside. But we've also got a good chunk in Europe, and a nice exposure to Asia, including developed Asia. So we've got quite a big business in Australia, for example. On a look-through basis, about 75% of the investments are US dollar denominated. And then finally, in terms of company sectors, given what I've said earlier about the sectors that are profiting from tailwinds and where we think there's some interesting opportunities in the future, it probably won't surprise you to hear that a majority of the portfolio is invested in information technology and healthcare. And those two sectors have been growing over time. And that actually predated the COVID crisis. So that's been a long-standing area of investment for us. What has reduced over the years is consumer. So nowadays, our major emphasis within consumer is consumer staples and consumer services. So, for example, we've got quite a few food and food technology businesses in the portfolio. On the consumer discretionary side, we're invested in e-commerce, and there's a number of examples of that in the portfolio. But we've shied away from areas such as travel, leisure, and hospitality. And we were actually doing that before the COVID crisis. So when we went into COVID, we only had about 2% of the portfolio that was invested in those sectors that were badly hit. And actually, as a result, that meant that we weathered COVID pretty well. Industrials, another big area of the portfolio, and financial and business services. Energy is just 4% of the portfolio, and that's also been reducing over time. So that hopefully gives you a good overview of the portfolio and how we're positioning it for the future as well. So maybe just turning to results, which I know that everybody will be interested in. So I mentioned earlier that PIP has been around for a long time. It's 35 years old. It's registered a growth in NAV over that time of 12.1%, net returns, which we're very, very proud of. Total shareholder return over the last 5 years has been 83%. And you can see there the returns for the 1, 3, 5 and 10 years. And we're also proud that we have outperformed public markets over pretty much every time period, I think, except for the 3-year MSCI World number. And that's really our aim. Our aim is to produce long-term capital growth in a sustained way by building an all-weather portfolio, which is well positioned against the challenges of today. And along the way, actively manage the portfolio, partner really with the best private equity managers in the world, adhering to the best ESG standards, and Pantheon and PIP has a very long and proud history in promoting the right ESG standards as well, and really provide a solution for investors that want to get access to private equity in a cost-effective and liquid manner. And with that, maybe I'll stop there and see if there are any questions.
There's some really interesting things you pulled out there, which I suspect people often don't think about for private equity firms or funds. I think one of the areas that you talked about was some of the things other than investing that you do. And I wonder whether you think actually private equity is a bit of a misnomer as a name, and what your business does is more about private equity management support and expertise. So if you were to break down Pantheon as an organisation, I know you've got funds other than the quoted investment company, how much time, how much resource is there for things other than investing in the organisation?
Oh, that's a great question. It's a really good question, actually, because I think people would agree that capital, money, is a commodity. What actually makes the difference is expertise, and human resources, actually. So we spend a lot of time developing our human resources, both as an organisation ourselves at Pantheon, but also with the managers that we work with. So we partner with the very best managers in the world. They themselves, in addition to sort of the money people that put together the deals, have these experts on staff. And that's really what the companies, the portfolio companies, are looking for. They can get money in many different ways. What they really want is the expertise to be able to help them accelerate the growth of their businesses. So when an entrepreneur or a family or a set of founders is looking to sell a significant stake in their businesses, they will choose their investor, and they will want to partner with people that can provide the long-term relationship that they need to grow their business over the next 5 years. And then coming back to alignment of interest, that's really important, because they need to find a partner they can work with in a very sort of aligned manner, so they can grow their businesses and everybody can make money at the end of the day.
Have you got some examples of where you've added value other than simply throwing money at a business?
Yes, I mean, I gave the example earlier of Olaplex, which I think is really interesting, because I think that business, if it had not had private equity funding, would have been left high and dry by COVID. So I think that's a really good example of where a business has been utterly transformed by private equity coming in, helping the digital transformation of that business, and actually helping position it for the longer term. But there's plenty of other examples. I mean, one example, maybe completely different, but radiology centers in the US. So we've just invested in a group of radiology centers. It's actually the second largest in the US, and they provide sort of things like MRI scans, CT scans, out of hospitals in the US. It's a very fragmented market in the US. It's about 6,500 of these centers, and this company operates about 120 centers. They're the number 2. So you can see there's a lot of consolidation opportunities there in a fragmented market, and that's actually a very good way of creating value. So what we'll do there, alongside our partner in the business, is to help that company find acquisition opportunities. So they can pick off, 2 centers here, 3 centers there, bring them together, and therefore create a much bigger bigger business, which will be more efficient, more effective, provide better customer service as well. So that's another good example, actually, the way in which we can add value. So, central expertise in helping with things like M&A, central expertise to help companies, things like the digitalisation, which I mentioned, but also supply chain management. Going back to COVID again, at the beginning of COVID, a lot of companies struggled because initially, if you remember, COVID started in Asia, and a lot of companies found their supply chains completely shut off because of what was going on in China, and therefore had to find other sources. Again, private equity managers are able to come in and help companies find other sources of materials, components to help them carry on.
So it's as specific as that in terms of business support, is it? It's not
it
just
really is.
Source of funding and that. That's interesting.
And maybe just one more thing, Keith. When we buy a company alongside our managers, there's almost like a sort of a SWAT team which is put on the company. They have a business plan, they have a sort of a 100-day plan, a 1,000-day plan, a 10,000-day plan. And it's very clear, and this is all agreed with management up front, what needs to be done. And the private equity manager will then throw these resources, human resources, at the company as a SWAT team. And they'll have 10 or 12 experts helping the company management in every facet of their business. And it's very specific, as you just said.
I think it was slide 8 in the presentation that referred to disruptive markets, which are underrepresented in the public market. Why do you think that is, and why is it that PE is able to help and understand and invest, whereas investors in the public market struggle?
Yeah, I think that's a great question, actually. I think it goes to the core of things, because it's actually, some of these businesses are growing extremely fast. They're growing extremely fast, but they need to reinvest in their businesses. As a public company, I think it can be quite difficult to do that, because you need to be able to show results and show results quite quickly. If you want to actually grow, for example, in a healthcare business, you want to grow a new line of products or grow into a new geography. I wonder whether sometimes public markets can be a little bit too impatient and want to see the results straight away. Whereas private equity, because there is a much longer time frame, you can hold these businesses for years, and it doesn't matter if you hold them for 10 years. These companies, so there's a much longer time period there, and I think there's more understanding of having to reinvest in the businesses. The other thing is that some of these businesses that we invest in are literally in very small niches. And I think that could be quite difficult for public markets to understand. And some of these niches really take a lot of development. And again, maybe not being able to be bucketed in particular sectors or particular areas maybe makes it difficult for public market investors.
You touched on the focus on technology and growth, which is obviously an area that covers a whole range of businesses, but also different stages in a life cycle, from venture through to businesses with revenues. How do you go about deciding where the spectrum should be, how the spectrum gets balanced, and which particular areas you invest in?
Yeah, it's really interesting, because you've touched on the fact that this is really this sort of continuum. It's a spectrum of investment. And we do invest right at that very early stage, where a company may not even have revenue. And that's really at the venture end. And there you're investing essentially in people with a very good idea, attacking what you think is a great market need. But by its very essence, it's a much more volatile part of the market, and we only invest about 4% of PIP's portfolio in venture, and that's actually both early stage and sort of later stage. And it's not just technology; it's also healthcare, so biotechnology, for example. So it's great; it gives a little bit of sort of high octane growth in the portfolio. And you'll see actually in the list of some of PIP's largest investments, there are companies there which started as absolutely tiny venture investments, literally just a few hundreds of thousands of pounds, and have now grown into the fabled unicorns. So, for example, Adyen, payments business, we invested there, when it was an absolutely tiny business, and now obviously it's a huge success. It's no longer in the portfolio, but Spotify, we invested in when it was, when it was really just sort of a glimmer in people's eyes and had not had the success that it has today. So we do a little bit of that, but the bulk of what we do is actually in companies that have revenue, normally have profits as well, and are just in a very fast phase of their growth. And it can either be through growth capital, which is where you take a minority position in the business and the founders or the family still control the business. And usually those businesses are growing. They can be growing at 25, 30, 50% per annum. So very fast growth, and they've got big capital needs. Or we can invest in buyouts of tech businesses, and about 30% of buyouts now, not just with PIP, but throughout the private equity universe, are actually in technology buyouts, according to Bain Capital. So these are quite mature businesses. They've been around for a while. They've certainly got profits. So some of these software as a service businesses, for example, would fall into that category. We like those businesses because they've got great recurring revenue. They're very resilient. If you're providing something like accountancy software to small and medium-sized enterprises, that's one of the last services that a company will cancel. It's very resilient, even in difficult times. So that's really at the buyout end of the spectrum. So we invest all the way through, but less at the most risky end and more at the more stable end of the market. We want PIP to be an all-weather portfolio that's going to do well in a variety of different economic environments.
I've got a question here from the audience about the shrinking of public markets. You've got a slide there about how there's been such a growth. There's been a growth in public equity investment, private equity investment rather, and a shrinkage in the number of quoted companies across all the mature markets. But the question really is, isn't that a problem as well as a positive? Because traditionally, floating a business was the obvious exit route for a private equity investment, wasn't it? Isn't that a difficulty for you?
Well, no, not really. And maybe that's another myth, actually. So only, in fact, less than 10% of the exits in our portfolio are through IPO. The biggest exit route by far for us is actually strategic sales. So 55% of our realizations, our exits, are actually to a strategic buyer. And then around about 35% are exits to another private equity fund. So that might be where we've invested in a growth round, and then the company is sold in a buyout to a bigger private equity fund. And just to give you an example of a company that we were in for many years, ZeniMax, developer of games for mobile phones, in a very, very successful company. We actually held that company for about 17 years, and it was eventually sold to Microsoft. And it was sold for a very big price because Microsoft needed that business. And in fact, when we invest in a company, when we're doing these co-investments or the single company secondaries, we are always looking right at the very beginning about how we're going to exit the business. And I sit on the investment committee, and I always get very worried if one of the investment professionals puts down, "Oh, we'll sell it in an IPO." That's not the primary route. We want to have an identification of the right strategic buyer for this business normally.
Another question here about really distinguishing Pantheon as an investment organisation from the investment trust. So Pantheon's organisation obviously has got a finger in many pies in the PE world, across the globe. And the question really is around how you, for the fund that's quoted, how you choose from the opportunities that come up from the Pantheon stable. You made a big commitment to the Pantheon secondary fund lately. I mean, why did you do that?
Well, no, so that's another great question. So Pantheon is a big organisation, has about $81 billion under management, so many clients, sort of institutional clients. But PIP has been around really almost since the beginning of Pantheon, 35 years. And PIP is governed by a completely independent board. So we have an independent board chaired by Solari Magnus. We have some private equity veterans on the board who really know what they're doing. And they challenge us, and they definitely hold us to account. But I suppose what I'm saying is that the strategy is actually set by the board. So we suggest the strategy, we recommend the strategy, but the board approves the strategy. And what we will do every year is have a full sort of strategy session with the board, talk about how we've done, talk about what we want to do in the future, and recommend what we should be doing. So a few years ago, pre-2015, we recommended to the board that PIP should be doing more co-investment, because we viewed that as a really exciting and interesting area, and we thought it would be interesting for PIP to be able to make more direct investments in companies rather than just investing in funds. And that's proved to be a huge success. And more recently, you're absolutely right, PIP has committed to the Pantheon Secondary Opportunity Fund, which was constituted last year, to take advantage of these single assets and single company secondaries that we saw in the market. And again, that was discussed with the board. The board really liked the market opportunity and viewed Pantheon very much as a pioneer and an expert actually in this part of the secondary market. So recommended that we made a commitment to that fund. So every client at Pantheon has its own strategy, but PIP is special because PIP does have the independent board, which sets the strategy and holds the manager to account.
I think I've got three what you might call structural questions. So the first one is, a lot of your presentation was about the S side of the ESG policy. Talked about growth and employment, how you support businesses. The question really is around the G bit and around governance in private equity. I'll give a quick plug there to a piece of research that Hardman published at the beginning of last year called The Real Costs of Public VPE Ownership, which gives our views on the subject. But Helen, what's your view about the G in private equity?
Well, we actually think that the G is one of the reasons for the success of private equity, because there is extremely strong governance in private equity. I mean, as I mentioned, in most cases, a private equity manager will control the business. So they will have people on the board of directors. They will be able to appoint the managers. So that they're very much in control of these businesses. But they're also completely aligned with the company management. So the company management invests alongside the private equity fund in the business. So they've got skin in the game, and they will exit their investment at the same time as the private equity manager. So essentially, if everything goes well in the business, then everybody will make money. So the company management, the private equity firm, the fund, and the end investors as well. So there's very tight governance. Also, there's very quick sort of feedback loops, because the private equity firms control the businesses. They can act very quickly if things are not going according to plan. And we saw that very much during COVID. And I'm sorry to give so many COVID-related examples, but it's very fresh in my mind. And there were companies that had problems in COVID. I gave the example of the hair salon business, products business. But other companies, for example, we had a physiotherapy set of clinics in the US, and they had to close down. What do you do? What do you do there? How do you try and save the business and save jobs as well? So the alignment of interest really goes very, very deeply in private equity, and this governance, this ability to take action. You don't really have the agency issue that you have in public markets, because the investors, can actually take action with the business. And Keith, you didn't ask me about the E. We talked about the S and now the G. But what about the E? And I did make a reference to to the green transition and environmental affairs. Increasingly we're seeing private equity firms find this as a really exciting area to invest in. So whether it's resource efficiency, or sort of circular economy, or helping to decarbonize industry. There's a lot that's going on there, and for good reason, because it is a huge area and it's not going away anytime soon.
Your philosophy to the discount to NAV. So like all investment companies, the share price doesn't necessarily equate directly to the NAV and can trade at a discount or at a premium. But the question is, do you have a philosophy about managing the discount to NAV, or is that something you just leave to the market?
So we don't have a discount control mechanism. We can buy back shares, and we do buy back shares, and we have done recently actually for investment purposes. But we always have to balance sort of buying back our shares versus the investment opportunities that we have in the pipeline at any one time. So it's a bit of a balancing act. I mean, clearly, Keith, maybe I can just say that we're very frustrated with the discount because, as you probably sensed during the presentation, we're very excited about the portfolio. We've got some great businesses there. We think there's huge value in the portfolio, and the proof of the pudding actually is in the eating. And when we exit our businesses, we track the cash that we sell the businesses for versus the last full valuation. And over every period for the last 5 years, we've seen substantial uplifts on exit. And in fact, in the last 6 months, the 6 months we just reported on, we saw an uplift of 43%. So I think and historically it's been between sort of 20 and 30% uplift to the last official valuation. So we feel very frustrated about the discount because we can see the value there. We can see the quality of the businesses, and we just don't think the market is recognizing the value. And I think part of it is to do with sort of this misconception about what private equity really is and what it does. And we're doing everything we can in terms of trying to get more information out there to talk about what private equity actually is and what it does, so that we can show the value there and what we're doing.
Well, not I'm going to make a recommendation, but many fans of Pantheon would say not only have you got a great management team and a great set of investments and NAV and all the rest of it, but you can buy it at a discount to NAV. So the final question I think for today comes from Robert, which is a sort of a long-term one. Understanding that private equity funds are generally invested for capital growth, but wonders whether there's any intention at any time in the future for Pantheon International to pay a dividend.
Well, it's clearly a question, for the board, because obviously the board looks at these things, but Pantheon International, is a capital growth vehicle. We are focused on providing strong capital growth. So if we paid a dividend, it would be sort of an artificial dividend. It would be manufactured out of capital growth because the sort of investments that we're investing in are not yielding investments. This is not an infrastructure type investment. So it would be a sort of an artificial dividend. And to be honest, I'm not sure whether paying a dividend would be welcomed by all of our investors. That there are sort of tax inefficiencies, I think, for paying a dividend. And the other issue is, in terms of the discount, we've done a little bit of work on looking at discounts and dividends, and there doesn't seem to be any correlation between, at least in listed private equity, between paying a dividend and the level of the discount. So, we'll continue to keep it under review, but it is a capital growth vehicle fundamentally.
Helen, thank you for that. It's been a really insightful session. You've covered a number of topics which I suspect people don't think about when they talk of private equity. Have you got a couple of sentences you'd like to say just to wrap up and talk about the opportunities there are for the trust?
Yeah, I mean, I think it's a really exciting time actually for private equity and for the trust. We've got a very full pipeline of investments. Not just in information technology, which I know I've spoken a lot about today, but also in the healthcare area and in the other sectors that I touched upon. And I think in periods of difficulty, we've got all sorts of issues in the environment. I think private equity is really well positioned. It's the most active equity that you can have. It's super active equity. It's not just capital flowing into companies. it's expertise, and it's expertise to be able to provide growth that we need. So growth in our investments, clearly, but also growth in the economy and growth in employment. So maybe just leave people with that thought that, private equity really is funding our future.
That's fantastic. I think that's gone a long way to dispelling some of the myths around the private equity space. Thank you very much for that. Thank you, everybody, for taking part today and sparing us your time to hear the story about Pantheon and private equity. And thank you for listening to this Hardman Talks. Thank you very much.